So, I've recently added 2 new companies to my portfolio, and you might want to take the chance to guess these 2 new additions in the comment section down below. Before revealing the answer, I will quickly run you through a few rule of thumbs that I've usually followed, and then share my elevator pitch for each company, so stay on if you want to find out. Also, given the rising interest rate environment today, money market funds and even fixed income and safer instruments seems to be gaining lots of traction, and I'll be sharing my opinion on them later on in this video. So here's the 4 general rules that I personally practice. First, I'm not in search of the next Tesla or Amazon when they're in their early stages. I'm not looking essentially for 100 or 1000 bagger. I do believe that the sweet spot for growth is right between 8 to 12%. So this probably means that the company is not at a high growth stage, yet at the same time, they're not dinosaur enough to only grow alongside inflation, like 2 to 3%. So in essence, I would just like to take part in the company's growth stage where it's proven itself to be both profitable and harvesting yield for shareholders by giving out dividends or even buying back shares. Second, I do pay quite a bit of attention to the valuations of the companies before I enter, and they have to be fairly attractive. Usually, I try to hunt for companies with a forward price to earnings of around 10 to 20 times. The lower the better, of course. But at a 20 times price to earnings, this would mean that there's minimally a 5% earnings yield and also maybe a 4% free cash flow yield if possible. However, companies might be undergoing some temporary issues that might hit both their free cash flow and also their earnings, which would skew this financial ratio. Therefore, it is probably more important to pay closer attention to their earnings and free cash flow trend over the last 3 to 5 years rather than just the trailing 12-month figures. Of course, there are always worries that the company might be undergoing some sort of structural transformation or even in an extremely competitive environment, which might cause the bottom line to be permanently impaired. So in those cases, you need to take extra precaution. Therefore, there is a lot of discretion and also judgment involved, which might make this an extremely tricky process. Also, since I tend to accumulate over time, as long as your initial buy entry was already at a relatively discounted price, as the stock continues to fall like a rock, you can slowly average in. So on a side note, I think you should start averaging into the like button as well, in case you have missed it. It's going to rally soon. Ha! Third, companies that I choose need to be strong leaders in their own domains and have also proven themselves to be both profitable and competitive with a recognizable brand. Fourth, all of them must have taken a beating, which suggests that there is a significant enough drawdown from their all-time high prices, signifying that the markets clearly don't favor them right now. And it's even better when your friends and families hear you have the stock, they will laugh at you. For now, it seems like only Chinese tech can hold that title. So the first stock on my list is LVMH, and here's my elevator pitch. So year to date, it's down 3% with a 25% drawdown from its all-time highs. So LV essentially operates as a luxury ETF. So even though I'm not necessarily a fan of luxury goods, but I'm definitely a fan of the profit margins these products offer. So LV's growth over the last 5 years have been slightly all over the place, from negative 10% in 2020 because of the pandemic to plus 34% in 2021 because of the huge rebound and the low base effect. But they're likely to normalize and fall within the 8 to 12% range soon. So on a much macro level, the luxury business will always be a rather profitable one. They're essentially tapping onto 3 of the 7 deadly sins: pride, envy, and greed. So the more pertinent issue for many investors out here is whether LVMH will continue to retain the position and prestige in the luxury industry. So this term prestige makes or breaks every investment thesis in the luxury industry. So if it's so good, why is LVMH stock price collapsing? So a recent report from RBC Capital Markets actually signals that the end of the luxury super cycle might be near. So long story short, they are skeptical of the most recent consumption boost by the aspirational consumers, and the numbers are dwindling. Growth rates should also be moderating from here. So to add, with all this interest rate, inflation and recessionary talks, average consumers probably have lesser residual income left over, and this would actually have a seismic impact on the entire luxury market. So looking at LV's PE over the last 20 years, there is definitely some sort of awakening amongst investors that hey, maybe we shouldn't be paying too high a premium for it. So for now, most of the financial metrics like ROE, ROIC all looks really healthy and attractive. But I would just like to warn any potential or even existing investors that it might take some time before we see the real impact of this slowdown. And hence, it seems like the market is trying to front run this collapse. So to me, it's currently a starter position at 0.7% of my portfolio and also my first step into getting exposure in the luxury market. So if you're interested in a deeper dive into the company and maybe even my price target or price valuation, leave in the comment section down below and your wish might be granted. The second stock that I would like to talk about is S&P Global. So SPGI compared to LV is a much more boring and boomer company. Year to date, it's up 9%, but from its peak, it's down roughly 23%. So I think I don't need to explain much about what the company does. They're essentially in the credit rating, analytics, and ETF business. So even though the ratings business might not be a very exciting one to be in, and sometimes might be filled with controversies like in the 2008 Great Financial Crisis, but it's a liability that needs to be outsourced with a moat so strong that the oligopoly between Moody's, SPGI, and friends is not so easily disrupted. So I think many people will recognize the SPGI as a high quality business, but maybe not so attractive a valuation, especially if investors are expecting for lower business and ratings activities moving forward as the economy slows. So for context, it's currently trading at a forward PE of 29 times, and it is definitely a huge ask for many investors that are much more conservative. Similarly, if you're interested in a deeper dive into the company, leave in the comment section down below, and I might actually talk about it. I think on the second topic that I wanted to pivot over is really this recent discussion that I've seen amongst the communities online, where there is this term that is being thrown around called T-bill and chill. So this idea of buying T-bills and just chilling really is riding on the back that a lot of all these fixed deposits, short-term instruments, the yields on all these instruments have been climbing and they're marching ferociously upwards. And I think in the current or the recent 10-year yield, US 10-year yield, it's a lot closer to 5%. 2 years ago, there was this term called TINA, which is there is no alternative. There is no point putting into fixed income or many of these safe instruments because they're yielding pathetic returns. So all of us just congregate to the equities market. This is probably one of the best rewards campaign that I've seen thus far across many of the brokerage platforms out there. And it's Webull's Moneybull promotion. So you can essentially win free cash vouchers worth up to $3,000. But let me basically explain how this works. So it's essentially a two-part mechanism to this campaign period. So the first part is really trying to encourage new and even existing users to deposit fresh funds into the platform itself. And if you just hit the bare minimum, which is US 5,000, you can actually get a bonus, the first bonus, which is get $120 US dollars worth of cash vouchers. And the second part is really to allocate this capital into Moneybull, which is essentially a wealth management tool that is offered by Webull. So this campaign period is very, very tight. I apologize for not producing this video earlier, but this campaign actually ends next Monday, Singapore time, 15:59, which is 4 p.m, before 4 p.m. So I think especially in this kind of high interest rate environment, many of these debt-based instruments like T-bills, bonds, and even fixed deposits have become the first choice. And one of the more important factors when you consider many of your investment decisions is really this idea of liquidity. But despite favoring many of these debt-based instruments, you might miss investment opportunities because many of these instruments are much more less liquid compared to cash. So in other words, if the market actually tanks today, you think that there's an opportunity to buy the dip and you wish to, you might actually miss the chance because you are invested in many of these debt-based instruments and you can't withdraw out or convert them into cash as quickly as the market trend turns. Let me introduce to you Moneybull, which is essentially a wealth management tool Webull offers. So without a lock-in period, Moneybull actually helps you earn a yield by investing your idle cash in underlying cash funds that still give you the buying power to invest in the stock market. So rather than getting your cash locked up in some of these debt-based instruments, you can actually subscribe to Moneybull and start earning yield on your cash while maintaining its liquidity. So the Moneybull's underlying cash funds are portfolios consisting of short-term and low-risk debt securities. But although it's low risk, it does not mean it's risk-free, so don't mix them up. So another good thing about Moneybull is that you don't need a lot of money to start with. So you can deposit as little as $10. And Moneybull does not charge any fee for Moneybull. So the yield of the cash fund varies depending on market conditions, but they are typically higher than some of these debt-based instruments. So considering that this is a highly liquid instrument, I think that the yield is pretty amazing. And of course, just a disclaimer, past records are not indication of future performances. So of course, if you want to subscribe to Moneybull, you have to first have a Moneybull account and you can sign up with the link below. Now, let me walk you through Moneybull's app so that you can take advantage of this rewards campaign. So for context, of course, you'll need to first sign up for a Moneybull account. You can use my link in the description below. So you might ask me, hey Chiking, how much are you supposed to deposit? Because we are currently living in Singapore. What we transfer in most likely would be in SGD, and many of these campaign rewards are denominated in USD. So specifically for this event, they fixed the exchange rate to be SGD1 to USD0.7297. So just doing some simple math, 5,000 divided by the exchange rate, you actually need to deposit at least $6,852.13. But in this case, I think I just round up the number because I just want to qualify for the first tier. I'll just deposit $7,000 in this case. Go under Promotion Center, and this is the existing promotions that Moneybull is currently running. Go to the up to $3,000 cash voucher, which is the current promotion that we are talking about. Click into the banner and then tap Participate Now. You have successfully registered and you need to go into deposit now. So after tapping onto Participate Now, you can see that this is essentially the mechanism of the campaign reward which I've explained. So step 1, after you click Participate Now, and then you need to activate Moneybull in your Moneybull app. And the second thing, of course, the second qualifying criteria is to accumulate the deposits and to not transfer your fresh funds out until the end of this year. So I've already deposited my account just now. You can see that just now it was around $16,000, and when I head over, it was within less than a short span of 10 minutes. And the account value has went up to 23,000. So after transferring the fresh funds in, you can see that under the details section, this is the extra cash balance that I have, which is 7,000 Singapore dollars. So to get the bonus tool, you basically want to tap onto the cash yield with Moneybull. What you have to do is to go back to your assets page, click onto the top right, under the SGD Fund. You can see that my SGD Fund is already activated to it. Oh, and did I also mention that for new users who haven't signed up to Moneybull before, you can potentially claim free shares worth up to $2,000 US dollars if you fund and maintain any amount for 30 days. And you can basically just do whatever I've did to take advantage of the new campaign and also the sign up rewards campaign. So for those of you who have yet to sign up, I honestly don't know what you're waiting for. So the sign up link will be in the description. I'll also leave the terms and conditions link below if you're interested. And of course, thank you Moneybull for sponsoring this video. But I'd like to say, even though this is a sponsored content, personally, I have been an avid user of Moneybull. As you guys can see, I do have existing positions there. And for those of you who have any questions, feel free to leave in the comment section down below as well. So I think to just wrap up this entire discussion, we talked about money market funds, we talked about short-term debt instruments, and now we also talk about investing. So then some of you might be concerned, or some of you might be thinking, so Chiking, what are you exactly doing? Personally for me, I do understand of the different concerns, but I think the fundamental question that you have to ask yourself is, what is your financial objective? Because different people are at different life stage, and different instruments are suitable for people with different risk appetite and different time horizon. Personally for me, I do see the appeal of parking some of your cash, and in fact, part of this 7,000 Singapore dollars that I just deposited is part of my emergency cash. For those of you who are much more younger, I do believe the equities market is still the way to go. But it really doesn't harm you to park some of your money in some of the safer instruments. That said, on the flip side, for somebody that is much more closer to retirement, the fixed income, the safer instrument really should take up a bigger part of your portfolio. So there really isn't a right answer per se on what you should do. Sure, many people would like to pull out the S&P graph and say that over the last 100 years, they're up like 8 to 10%. But really, there is no guarantee. But that said, I think as retail investors and even consumers in this broader market, we should take advantage of everything that comes our way. So with that, I'll see you in the next video. But more importantly, I'll see you on the moon. Goodbye.